All right, today we're taking a deep dive into the future, specifically the 2026 economic forecast. Now, the official predictions are out, and they're painting well, let's call it a stable picture. Not booming, not crashing, just, weak but steady growth. But if there's one thing we've all learned recently, it's that the official story, that headline number you see on the news, is almost never the whole story. It's kind of like this. Someone can tell you the water's warm, but they don't mention the crazy strong current right below the surface. So what's really going on behind that curtain of official predictions? Today, we're going to peel back the layers.
And that's really the question we're digging into today, right? We're not just going to sit here and read you the official numbers for GDP, the stock market, jobs, and inflation. I mean, anybody can do that. Instead, we're putting those numbers under the microscope. We're going to look at a critical analysis that calls that whole mainstream story into question. We're going to read between the lines. What are these numbers not saying? What assumptions are they making that just might not be true? That's what we're here to figure out.
Okay, before we really get into the thick of it, a quick note. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Your support really does help us make more deep dives just like this one.
So, here's how we're going to break it all down. First up, we're going to tackle the whole idea of economic growth in a section we're calling the 2026 Growth Illusion. Then we'll pivot to the financial markets to look at the predictions for record highs versus some pretty big hidden risks. After that, we'll get into this economic tug-of-war between things pushing us forward and things holding us back. From there, it's a deep dive into what's really going on with the official unemployment numbers. And finally, we'll unpack the biggest contradiction of all, the bizarre dance between rising inflation and what the Federal Reserve is expected to do. Let's get started.
Okay, let's kick things off with our first big topic, the 2026 Growth Illusion. We have to start with the big one, Gross Domestic Product, or GDP. You hear about it all the time. It's supposed to be the ultimate scorecard for how the economy is doing. But what if that scorecard isn't just a little off? What if it's telling you the complete opposite of the real story?
So here it is. The official government forecast is calling for 1.9% GDP growth in 2026. That's just a tiny bit higher than the 1.8% they expect in 2025. And look, on the face of it, you see a positive number, and you think, hey, that's good news, right? A plus sign means the economy is moving forward, the pie is getting bigger. It's not some roaring 3 or 4% boom, but hey, growth is growth, isn't it? It suggests we're making more, selling more, earning more. But this little number, 1.9%, is what's called a nominal figure. And in economics, nominal can be a very, very tricky word.
So that really begs the question, doesn't it? Is this real growth? I mean, is the average person's financial situation actually getting better if GDP is going up by 1.9%? To get to the truth, we have to look past that headline number and bring in the one thing that impacts every single one of us every single day: inflation. And this is where that simple positive number starts to fall apart.
And here it is. This is where the illusion becomes clear. While GDP is supposedly growing by 1.9%, the same official forecasts are saying inflation is going to be over 3%, peaking at 3.3%. Let's make this personal, because that's what matters. Imagine your boss gives you a 2% raise, but at the same time, the cost of your groceries, your gas, your rent, all of it goes up by 3%. Are you really better off? No way. You're actually going backwards. Your paycheck is technically bigger, but what you can buy with it has shrunk. Well, the same thing applies to the whole country. When inflation is higher than growth, the economy, in real terms, is shrinking. That's literally the definition of a recession, but it's being hidden behind a positive number.
Okay, so if the economy is really shrinking when you factor in inflation, how in the world can that official number still be positive? Well, the answer is in how they calculate GDP in the first place. And the key is right here. Get this. A whopping 70%, almost 3/4, of the entire U.S. economy comes from just one thing: consumer spending. That's you and me. Every time we buy food, pay an electric bill, fill the car with gas, it all gets counted and added to the GDP. This means that number, that supposed measure of our economic health, depends almost completely on us just continuing to spend money for any reason at all.
And this quote just hits the nail on the head. The spending that's holding up that 1.9% GDP number, it's not a sign of a healthy, confident country. This isn't you and me feeling great about the future and deciding, you know what, let's buy a new car, or let's finally redo the kitchen. No, it's driven by something totally different. It is, like the source says, spending that people have to do in order just to be able to survive. Think about it. When gas prices jump 20%, you're forced to spend more money just to get to work. That extra spending makes the GDP go up, But is the economy stronger? Of course not. It just means your budget got tighter. When your rent goes up, you have to spend more. That makes GDP go up, but you're not better off. That's the illusion. An economy that looks like it's growing, but only because the price of just staying alive keeps going up. It's not optional spending, it's survival spending.
All right, so let's switch gears a bit. How does this huge disconnect, this gap between the official story and reality, how does that show up in the financial markets? If the actual economy is built on such a shaky foundation, where do the experts think the big money is going to flow in 2026? The answer shows this deep, fascinating conflict about what the future really holds.
You'd think with everything we just talked about, Wall Street would be a little nervous, right? Well, think again. The mainstream forecast for the stock market is shockingly positive. The prediction is for the S&P 500, the big benchmark for the whole U.S. market, to hit a new all-time high of 8,000. That's a 15% jump from 2025 levels. Now that signals a huge amount of confidence. It's basically Wall Street saying they expect company profits to soar and the party to just keep on going for investors. It's a forecast that feels totally disconnected from the reality of a consumer getting crushed by inflation.
But here's where it gets really interesting. The analysis we're looking at tells a completely different story about where the smart money might be going. It predicts that old-school safe havens, specifically gold and silver, are going to see gains that far surpass the stock market. Now, this isn't just a small disagreement. It's a fundamental clash of worldviews. The mainstream view is betting on growth. This other view is betting on a flight to safety. People buy gold and silver when they're worried, when they lose faith in paper money in the economy. So a prediction that they will outperform a red-hot stock market, that's a sign of some serious fear hiding just below the surface of that rosy S&P 8,000 forecast. So this really sets up this massive tug-of-war happening inside the real economy for 2026. You've got these powerful forces, these boosters, trying to push things forward. And at the same time, you've got these heavy brakes trying to pull everything to a halt. The outcome of this fight is probably what's going to decide which of those forecasts we just talked about actually comes true. So let's start with the boosters, the things that could actually give the economy a lift.
So what's on the positive side of the ledger? Well, the single biggest thing is a predicted surge in tax refunds. We're talking about an extra $55 billion being pumped directly into the economy. The average refund check is supposed to be about $1,000 higher than last year, and this is thanks to some new tax deductions for things like overtime pay, tips, and even the interest on car loans. That's real cash going right into people's pockets. On top of that, you still have the tech sector, which is just a powerhouse. The money pouring into AI and the data centers to run it all is a massive force creating good jobs. So these are real, tangible positives.
But, and this is a big but, for every one of those positive forces pushing forward, there's a heavy anchor pulling things back. The analysis points to several huge parts of the economy that are basically acting as a drag. The housing market, which is so important for wealth and construction, is still weak, stuck between high prices and high interest rates. Our manufacturing sector, the part of the economy that actually makes stuff, is really struggling. Even some service businesses are hurting as people are forced to cut back. And maybe the most important break of all, overall job growth is expected to be slow and weaker than normal. So that's the conflict, a potential one-time cash boost from tax refunds and AI fighting against deep, long-term weakness in housing, manufacturing, and the job market.
All right, we are right at the midpoint here, and before we dig into the job market and the Fed's huge gamble, just a quick reminder, before we move on, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, let's get back to it.
Okay, so let's dig into one of those huge economic breaks we just mentioned, the job market. This is another one of those areas where the official headline number tells you one thing, but when you look a little closer, the data reveals something completely different and a lot more worrying. It's really a tale of two different unemployment rates.
Here's the official number, the one you'll hear on the news. The prediction is that unemployment will peak around 4.6% in early 2026. Now, to be fair, that's not a huge jump from where we are now, and historically, anything under 5% is usually seen as pretty healthy, a sign of a good job market. So if you only looked at this one number, you might think the job market is pretty solid, a source of strength. You wouldn't see any reason to be alarmed.
But that official number leaves a lot out. This analysis argues that we need to look at what it calls functional unemployment. This is a much wider, more realistic number. It doesn't just count people who are officially jobless and looking for work. It also includes the underemployed. Like, think of the person with a PhD who's working part-time at a coffee shop because that's all they can find.
It also includes all the people who have just given up looking for a job entirely. And when you add all of those people together, the analysis estimates the real functional unemployment rate is closer to 25%, 1 out of every 4 people. Look, the gap between 4.6% and 25%, that's not a small difference. That is a chasm. It's the difference between things are okay and a full-blown crisis hiding in plain sight. And that brings us to our final piece of the puzzle. And honestly, this might be the most important one. This is where we look at this strange, almost nonsensical relationship between the inflation forecast and what the Federal Reserve is predicted to do. This is where the official story seems to completely contradict itself, setting us up for what could be a massive, risky policy gamble.
Okay, just look at these two predictions side by side because putting them together is what makes this so confusing. On one hand, the consensus forecast is that the Federal Reserve is going to be cutting interest rates. Now, cutting rates is like hitting the gas. It makes money cheaper to borrow, and it's supposed to boost a weak economy. But on the other hand, the same forecasts predicted inflation is actually going to rise to a peak of 3.3%. So think about that. The Fed is expected to be hitting the economic gas pedal at the exact same time the engine of inflation is already starting to overheat.
So what gives? How on earth can both of those things be true at the same time? I mean, basic economics, the stuff they've been doing for decades, says you raise interest rates to fight inflation, you make things more expensive to cool the economy down. So why would the Fed do the exact opposite? Why would they hit the gas when inflation is already a problem? It's a huge contradiction. The only logical answer is that the underlying economy, with that 25% functional unemployment, is so fragile that the Fed is actually more afraid of a massive recession than it is of high prices. They might be forced to choose the lesser of two evils, let prices stay high to keep the job market from totally collapsing. It's an incredibly dangerous gamble.
And just when you think it can't get any more complicated, there's a huge wild card that could get tossed into the mix, something that would change the whole game: another round of government stimulus checks. The idea of something like a $2,000 tariff dividend check is out there being discussed. If something like that actually happens, it would mean injecting a massive wave of new cash directly into the economy. And this quote, man, it just nails the biggest fear here. It says that as a country, everybody seems to have amnesia about what happened last time we got all this stimulus. We don't have to guess what happens when you pump trillions of dollars into the economy. We just live through it. Those stimulus checks back in 2020 and 2021 were a lifeline for a lot of people, no doubt, but they also poured gasoline on the fire of inflation. The fear is that another round, coming at a time when inflation is already rising and the Fed is already cutting rates, would be catastrophic. It could push that 3.3% inflation prediction way, way higher and make the Fed's job basically impossible. Okay, so let's just step back and recap the big takeaways from all this. First, that 1.9% GDP growth number, it's probably an illusion. Once you factor in inflation, the economy is likely shrinking. Second, all that consumer spending that's holding the economy up, it seems to be driven by the rising cost of survival, not by a strong and confident consumer. Third, that nice-looking 4.6% unemployment rate is almost certainly hiding a much bigger problem of functional unemployment, maybe as high as 1 in 4. And finally, the Fed's game plan of cutting interest rates while inflation is going up is a massive contradiction. A huge gamble that shows they're more scared of a recession than they are of high prices. So, at the end of the day, what's the point of all this? Well, the goal today wasn't to predict the future. It was to give you a new way of looking at the numbers, a critical lens to see past the headlines. So the next time you see a story about GDP, or the job numbers, or what the Fed is doing, the real question is this: will you ask, what's hiding behind the number? To support your journey, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Thank you for watching.